interest rates never came down, mortgage rates are remaining elevated, and therefore buyer demand or sales volume is remaining very, very depressed. You have tight inventory on the existing side, you have swelling inventory on the new construction. Wherever you are, whether you're in a tight or a loose market, the trend is going to be towards a looser or more price pressure situation.
Eric Basmajian returns to the show. He's an economist and the founder of EPB Research. We'll be revisiting his calls from last year when he was on the show about the economy and the labor market, and he's going to give us his update on where the economy is headed and which sectors investors should be looking at right now. Welcome back to the show, Eric.
Good to be with you, David. Thanks for inviting me back on.
We're going to talk about growth, the labor market, housing, which is something you cover in detail. Let's start with the labor market. Last year, you were on the show. You were calling for potentially millions to lose their jobs. Well, millions have lost their jobs over the course of the last year. The unemployment rate has ticked up to 4%. It was much lower when we spoke exactly a year ago, Eric. But has the labor market grown or, I guess, progressed the way that you had expected?
So last year when I was on the show, the unemployment rate was in the range of 3.4 to 3.5%, which was the lows of the cycle. Now that we have the ability to look back, we have increased 60 basis points from the low point in 2023. So the unemployment rate is up to 4.0% now. So that general trajectory or that general upward trend in the unemployment rate is certainly what I expected last year. However, there are certain pockets of the labor market that have held up better than I would have expected, which would have pushed the unemployment rate even higher than the 4.0% we're seeing right now. Generally, as economic slowdowns develop and the unemployment rate rises, job losses come from basically four categories. That's what pushes the unemployment rate up initially. Those four categories are temporary help services, trucking, manufacturing, and residential construction. There are a few other industries associated with those four, but those four categories make up about 20 million payrolls. And those categories are what we would call very cyclical. And those categories are ones that shed jobs first and cause the initial increase in the unemployment rate. Over the last year and a half, we've seen very heavy job losses in the temporary help category, and we've also seen fairly heavy job losses in the trucking category. There's been basically a net flat or no growth or no contraction in manufacturing employment, but residential construction, that fourth category, has actually added jobs over the last year. So of those four major categories, two of them are shedding jobs, one of them is flat, and one of them, residential construction, which is arguably the most important of those four, has continued to add jobs. So we are seeing the early signs of a slowdown in the labor market. That is what has caused the unemployment rate to go from its 3.4% low point up to its 4.0% level now. There are signs that that residential construction sector won't be able to hold up much longer, given some of the inventory situations we're seeing develop in the housing market. But that's the overall situation from the most cyclical parts of the labor market.
The GDP growth rate has slowed down in terms of its absolute numbers. U.S. real GDP grew at an annual rate of 1.3% in Q1, as opposed to 3.4% in the fourth quarter of 2023. How are you reading this slowdown? Is it in the territory that will start to worry you, or not yet?
So the overall deceleration of the economy is not something that's very new. I mean, we had peak levels of economic growth in early 2022. Then we saw a very abrupt slowdown into 2023, which coincided with some of the regional banking issues that we had in the first quarter of 23. Then growth stabilized for a large part of 2023. There were wiggles and oscillations, which come from some of what we would call the irregular components of GDP, like inventory, net exports, government spending. But overall, the economy never had this very significant acceleration. The trend level of economic growth never really had this acceleration in 23 that most people thought by looking at some of the wiggles in the GDP figures. We are seeing those GDP figures come down a little bit, but what I think is most important is to focus on the trend level, or to strip out some of those volatile elements of the GDP figures. So one common way to do that is what we would call real final sales. So you take GDP and you strip out the inventory, because the inventory numbers go up and down. Overall, they contribute nothing to GDP. They just cause a lot of unnecessary volatility. If we look out to Q2, the Atlanta Fed GDP now estimate has come down. It started the quarter at in the 3% range. The latest estimate has come down to 1.7, but 0.7 of that is coming from inventory. So that real final sales figure has come down to just 1%. So that is a pretty weak level of growth. And the weakness is coming from what we would call the more cyclical elements of that GDP. So the residential fixed investment, the business equipment investment, and some of the big ticket durable goods consumption. So there is a slowdown that's continuing through the US economy. We are seeing it in some of the early sectors of the labor market. As I mentioned, there needs to be a little bit more of that, and it needs to rope in residential construction employment before we get to be able to the point where we can declare that a recession is either here right now or imminently in the next quarter. Until we see residential construction employment fall, the economy does have a little bit of a buffer, because that's really the most important category there.
And importantly, last year you had informed my audience on my show. By the way, you can check out Eric's interview with me last year in the link down below or up here. You had told us that the NBER, the National Bureau of Economic Research, does not consider 2 quarters of consecutive negative GDP growth as indicative of a recession. It's happened before, and there was no recession called, right? They look at other factors. So you mentioned
Exactly.
some of them before, including industrial production. Which other factors do you think or criteria are flashing recession indicators, if any?
Yeah, exactly right. So in 2022, we had 2 consecutive quarters of negative GDP. There was a lot of, political fanfare about, is this a recession? Did they change the definition? Of course, with the ability to look back now in hindsight, it's obvious that those 2 quarters of negative GDP were not a recession. There were no job losses. And if we follow the NBER business cycle dating procedure, we knew that 2 negative quarters was never the official definition of a recession. As we mentioned in the last podcast about a year ago, the NBER looks at 6 major variables in order to define the business cycle periods. They're looking at 2 different measures of employment, both the establishment payroll survey and the household employment level. They're looking at real retail sales, total real personal consumption, real personal income, and industrial production. There needs to be a simultaneous downturn in all 6 of those components in order for there to be a textbook definition of a recession. Right now, when we look at those 6 variables, we see the establishment non-farm payroll figures continuing to go up. We see those every single month, the plus 200,000s. But we have a clear peak in the household employment level. The household employment level is coming down. We know that there's been a divergence in those 2 surveys. So on the labor market picture, it is mixed. We have non-farm payrolls going up, household employment level going down. When we look at real retail sales, those have peaked and are moving to the downside. Real personal consumption, the broader category, is still rising. But if we look at the durable goods, the more important cyclical component, that has peaked and is coming down. Industrial production peaked all the way back in 2022, and real personal income has actually started to peak and come down. So we have a really mixed bag there where 3 to 4 of the components have established what looks like a cyclical peak, while some of them are continuing to rise. Now, we all know that this data can be revised with quite a bit of hindsight. But as we stand here right now, we do have a mixed bag. And I would remind the audience that those are what we would call coincident variables. They're not leading economic variables. So we can't use that to tell us where the economy is going. That tells us where the economy is right now. And where the economy is right now is far more vulnerable than where the consensus believes, considering that those big six variables, about half of them are flashing recession, half of them aren't. And when we look to the more leading components of the economy, just traditional things like the Conference Board Leading Index, the yield curve, building permits, ISM new orders, all of those things remain persistently in contraction, which would tell us that those big six coincident variables, the peak that we're seeing in about half of them, very well could continue and could broaden out to the whole basket.
I'm just going to comment on the leading economic indicator by the Conference Board, which you just brought up. It's been in contraction mode since 2022, Eric. So I think I've heard the argument that we should just throw that out the window because it just hasn't worked this cycle. What do you think?
Yeah, I think that that's not an appropriate way to use the index in business cycle analysis. Something that goes on for a long period of time doesn't negate the reason for why it's a leading indicator. So when the Conference Board leading index or any other leading index is constructed, it's not a bunch of voodoo that's put together in a basket that has a correlation that leads the economy, and now the correlation has broke. There are components to that basket that mechanically lead other elements of the economy. And unless we can prove that those elements mechanically no longer lead, then they still will have the ripple effect throughout the rest of the sequence. I'll just use one example to paint the picture, David.
Sure.
Building permits must lead new construction. You cannot build a new house without a building permit. So if we extrapolate that concept to the whole basket, which is what they try and do when they design it, unless you can tell me that building permits will no longer lead new construction, then we can't negate the effect that the whole basket has. Lead times have been extended, and using building permits as an example, on the multifamily side, it's taking 2.5 years to build a multifamily construction project when historically that was about a year and a half. That's due to various supply chain issues, labor market constraints, and a whole host of factors that happened in the post pandemic economy. So those lead times have undoubtedly lengthened out. But unless you can prove that a new order will no longer lead production activity, or a building permit will no longer lead construction activity, or the inversion of the yield curve will no longer disintermediate credit throughout the economy, we can't simply say that because it's gone on a long time, it won't work. Now, if all of those variables turned higher without the economy going into recession, then I would change my view that the economy avoided a recession this time. Leading indicators are turning higher, which means that some of those more downstream variables, like construction, like employment, like bank lending, those things will recover. But for now, we don't have that on the horizon, given what we know are the components of the leading indicators and their mechanical process of how they lead the downstream effects in the economy.
Okay, that's a good segue to talk about the housing market. Here's a recent headline from Reuters. U.S. new home sales slump, supply at more than 16-year high. This came in couple of weeks ago. Sales of new U.S. single-family homes dropped to a 6-month low in May as a jump in mortgage rates weighed on demand, offering more evidence that the housing market recovery was faltering. This sting from the largest decline in sales in more than 1 to 1.5 years, reported by the Commerce Department on Wednesday, was softened by a sharp upward revision to data for April, which now shows sales rising instead of falling as previously estimated. Supply was the highest in more than 16 years. All right, well, supply now at the highest level in 16 years. Is that a leading indicator for anything?
Yeah, absolutely. So when we're looking at the housing market, we always have to try and separate the existing home market and the new construction or the new home market. The existing home market by sales volume is about 6 times larger than the new home market. But the new home market, even though there's less sales and it's a smaller market, is more important to construction activity, residential employment, and is more impactful to the broader economy. So we have to look at both markets separately. When we look at the existing home market, we see a month's supply which is the best measure of inventory in the housing market because it takes into account both supply and demand, we see a month's supply of 3.7 in the existing home market. That's very, very low considering that a 6.0 level is what we would call balanced. There's really no upward or downward pressure. So the existing home market, which represents 85% of sales transactions, has a month supply of 3.7. That's very, very tight. Most buyers interact with the existing home market, which is why most people still say inventory is really tight and there's a supply shortage. However, what you just quoted was the new home or new construction market. And in that market, we have a month supply of 9.3, which is way higher than the 6.0 balanced level. So there is a lot of inventory accumulating in the new home market. There's still a tight situation in the existing market. However, when we look into the new home market, a lot of that inventory is either under construction or not yet started. Only about 20% of that inventory is completed. On average, 20 to 30% of new home inventory is completed. The rest is under construction. That's rising though. So what's happening in the new home market is there is a swelling of inventory as home builders built a lot in 2023, hoping that interest rates would come down and buyer demand would come back. However, interest rates never came down, mortgage rates are remaining elevated, and therefore buyer demand or sales volume is remaining very, very depressed. So as that inventory rises in the new home market, which it is, and a larger share of that inventory is completed, which it's now starting to rise, then home builders are going to slow down their applications for new building permits. They're not going to build anymore. And that's what's going to put the residential construction jobs at risk. So we are seeing a situation develop in the housing market where you have tight inventory on the existing side, you have swelling inventory on the new construction side. New construction is rolling from under construction to completed, which means that home building companies are not going to put new projects into the pipeline, which means as these projects roll from under construction to completed, they're going to start to lay off those construction crews. That's the missing variable in the labor market that's going to tip the scales from what people believe is more of a normalization in the labor market to something that's more akin to a cyclical recessionary slowdown.
Is there a reason new listings have gone up recently? I actually interviewed the Redfin CEO not too long ago, and he was telling me that
there's just a large number of active listings. The only reason those two metrics are different is because active listings also accounts for the fact that homes have started not to sell, that they're sitting on the market. And so when homes sit on the market, you start to see prices soften. The parts of the United States that were the hottest, literally, and in the market, Texas and Florida, now are seeing major price cuts, homes getting delisted because they can't sell. Almost every real estate broker is having conversations with home sellers about when you're going to mark this property down so we can get it to move. And real estate is just really sticky. It's not like other consumer products where manufacturer is very rational about the pricing and immediately drops its price whenever it sees a lull in demand. Homeowners are emotionally committed to their property. They have in mind a number and they're loath to give it up. And so that makes home prices stickier. But still, I think it's going to be a pretty soft summer for home prices.
are you seeing this trend? What can you make of this?
Yeah, so when we look at and I always like to look at month supply versus just looking at the listings, because if we have a million active listings and
Mhm.
we have you know a sales volume of 300,000, that's one thing. But if you have a sales volume of 900,000, that's totally different picture. So you always have to look, in my opinion, at the month supply, which takes into account sales volume and active listings. I mentioned that the existing home market was 3.7, very tight. The new construction market was 9.3. 85% of transactions are in the existing market, 15% are in the new market. So if you take the weighted average and you put them all together, the entire US single family housing market has a month supply of 4.5 as of May 2024. That's the highest level since 2015 if you take a yearly average. So inventory in the US housing market is creeping up. It's certainly at pre-pandemic levels. And if you take the yearly average, it's about where we were in 2015. Now, that's a national average, 4.5. But as we know, David, real estate is very regional. So if the national average is at 4.5, that means there are some markets around the country that are up at 6, and there are some markets that are down at 3. So you might hear people that say, well, hey, where I live, prices are going up and there's multiple offers. You may be in a market that still has a month's supply of 3, very, very tight. But if you're in one of the markets that's up at 6, then that's the area where you're starting to get outright price declines for both new and existing homes. So on a national basis, supply is still, a little bit on the tight side at 4.5. It's much higher than it's been over the last 4, 5, 6 years. And you have to look at the regional disparities because there are some regions that will be up at 6 or maybe even higher. And there is going to be price pressure, price cuts, as you mentioned, in those markets.
Let's pull the audience. If you're watching this right now, comment below if you're in a buyer's or seller's market. All right. So, Eric, what's your overall assessment of the real estate market right now? Mortgage rates being where they are, is that going to be incentivize people to sell right now?
The situation in the housing market now, if we're referring to prices, home prices, is that on a national basis, we're at 4.5, which means that if you look out 6 months from now, national home prices are likely to rise a little bit over the next 6 months if you take the new and existing home markets together. That's just a basic correlation of where we are nationally. Like I mentioned, there's going to be regional disparities. However, the trend in that month's supply figure is rising. We've gone from 3.5 to 4 to now 4.5, and the trend is moving higher. That trend, in my view, is going to continue to climb, and it could climb more abruptly if there are more significant slowdowns in the labor market. So, overall, my assessment of the US housing market is that conditions will continue to slow down. You're going to continue to get price pressure in the markets that have had the largest increases in inventory, namely Texas and Florida, as well as a few other pockets around the country. Where I happen to live in the Northeast, that's one of the markets that has a very tight or very tight inventory situation. But broadly speaking, the trend is for higher inventory, which means that wherever you are, whether you're in a tight or a loose market, the trend is going to be towards a looser or more price pressure situation.
The lumber price has also been falling. It's now at the lowest level since, I believe, 2023. Is this indicative of slowing demand as well, especially from the construction side?
Absolutely. So going back to what I said about the new home inventory situation, we have um, 9.3 months supply in the new home market. Or we have, I think the number is we have about 470,000 active listings for new homes, new constructed homes. But of those 470,000, 20% are completed or finished homes. 80% are either under construction or not yet started. As the share of inventory rolls from completed or under construction, excuse me, to completed, and that overall month supply figure stays elevated at 9, builders are not putting new permits into the pipeline. In the last 4 months, we've seen single family building permits decline as a result of that. That is definitely causing downward pressure on lumber. And to the extent that those inventory situations remain in the new home market, which I believe they will, then you're going to keep getting downward pressure on the commodities associated with residential construction. So I do believe that is a valid signal of what we're starting to see in the new construction market.
If you zoom out though, Eric, if you take a look at the lumber price back 10 years, it just looks like the price is normalizing post-COVID. Before the pandemic, it was trading around, I'm looking at trading economics, is around $430 per 1,000 board feet. It's about the same right now, 459.
Mhm.
So it doesn't look like the lumber price has collapsed from its historic mean. It's just down a lot from the build up after
Right.
the pandemic. So yeah, can you comment
Sure.
on this? Yeah,
So we sometimes it's better to look at relative prices
sure.
because most prices rose 20 or 30% from the pre-pandemic level and
Yeah.
have remained 20 or 30% above those levels. So the fact that lumber prices have actually come all the way back down to pre-COVID or even below pre-COVID levels, I think is indicative of an overall slowdown because most prices in the economy are remaining way above that trend line. So I think if you normalize lumber prices relative to something that's, other commodities, then I believe it would show more of a slowdown situation. Now, I take your point, though, that we're not seeing a collapse in construction activity, certainly not yet at all, but we're starting to see the signs that builders are pulling permits or just applying for fewer building permits because the inventory situation is rising in the new construction market. More and more of that inventory is rolling over to completed. So we're seeing early signs of a slowdown in the residential construction market. We are not seeing a collapse.
I was informed of the stats recently. 43% of small businesses polled cannot or have not fully paid their rent. This is across America. And so we're seeing this huge problem for small businesses. And I wonder how, first of all, can you comment on the small business sector of America and how they're doing? And second, whether or not the struggle that they're apparently seeing is going to translate to a further deterioration in commercial real estate.
This is a trend that we're seeing across the entire economy, whether we're looking at businesses or just individuals, corporations. Larger and larger shares of the pie are being accumulated by smaller and smaller people, whether that's just individuals or on the corporate side. For example, if we look at the stock market, I believe there was a report that came out today that said that the top 10 stocks have contributed to about 77% of the year-to-date gains, which was the highest share since 2007. So this trend is sort of unanimous across the whole economy, where fewer and fewer are taking larger and larger shares of the pie. That generally happens as economic growth gets weaker and weaker and weaker over time. This is more of what we would call a secular or a long-term economic trend. In my view, it has a lot to do with increasing government size, increasing government spending, which does lend itself to more oligopoly type situations. It's a little bit outside the realm of the traditional business cycle research that I do, but it is a broader trend that's developing both in the individual side, the stock market, and the corporation side.
Eric, I want to talk to you about some longer term demographic changes, which you've researched. But first, let's just summarize your overall findings for us. So, given your outlook on the economy, given the outlook on the housing market and the indicators that you're looking for, what is your overall thesis on growth and ultimately investment implications?
I believe that the path forward here for economic growth is to the downside. We're going to continue to have decelerations in economic growth. Um, a lot of people like to look at real GDP as the end all be all barometer of growth. And that's okay to do as a very quick reference. But as we mentioned in the beginning of this conversation, the NBER doesn't use real GDP to define business cycles, and it's not the most complete measure. GDP doesn't capture the income side of the economy. It's not measuring employment directly. And it also has very volatile swing factors like inventory that contributed to two negative quarters, which gave everyone a head fake recession in early 2022, even though there were no job losses. So if we take those six NBER variables, non-farm payrolls, the household employment level, industrial production, real retail sales, total personal consumption, and total personal income, those six variables, and we put them all together, economic growth as defined by those six variables is actually about 1% right now. Which is a lot lower than people perceive the economy just based on looking at the GDP figures. Although those GDP figures, as we mentioned, are actually converging towards that 1% level. So if growth right now is 1% And leading indicators, traditionally like the yield curve, building permits, new orders, monetary and credit aggregates, if those are pointing towards a continued slowdown, which I believe they are, there's not a lot of buffer room between 1% and zero or ultimately negative. So while the recession conversation has been going on for a long time, I absolutely do not think it can be taken off the table. So I think the path forward from here is a deceleration in growth. And given that we're already at 1%, we're in a vulnerable situation. I don't personally make direct calls on the stock market or anything like that, but I would overall have a general feeling of cautiousness, and I would be watching the labor market and most specifically residential construction. Within the labor market, residential construction employment as probably the most critical factor that would tip the scales either towards a more harsh contraction or more of the quote unquote soft landing scenario.
Do you think that there could be more of a rotation now into bonds, treasuries?
Well, the treasury market is generally, let's say, if you take the 10-year treasury, it's going to be a function of, to use a really simple example, the average Fed funds rate over the next 10 years, plus a little bit of a premium for, locking your money up for 10 years. So the fact that the Fed funds rate is up at 5.5 actually, and the 10-year yield is at 4.5 is clearly indicative of the fact that investors assume that over the course of the next couple of years, there will be interest rate cuts so that the average of that Fed funds rate is closer to 4.5 rather than 5.5. If the economy develops as I believe it will, then I think that the Fed will have to cut interest rates more than what's priced in now, which is effectively the Fed funds rate going to 4% by the end of 2025. That's somewhere in the ballpark of where the market is. Generally speaking, I think that the economy will progress slightly more negatively than what's priced in there, which means that the Fed will likely have to cut interest rates more than that. So I do believe that there will be somewhat of a rotation into bonds, or that yields will ultimately fall more than they have as a result of that.
On a more longer term basis, you have an interesting video on your channel, which I encourage people to check out. By the way, it's called EPB Research. I'll put the link down below in the description. It's entitled America's Income Crisis, How It's Triggering a Collapse in Birth Rates. This is a video you posted recently. Interesting piece of research. Can you summarize your findings for us?
If we look at the economy, there's a concept in economics called long run income or permanent income, which is you and we have somewhat of an estimate of where we'll be 3, 4, 5 years into the future. And we make longer term economic decisions based on that trajectory. So if you were to buy a house, David, you're not going to just take your income today and buy that house. You're going to try and make some extrapolation of where you'll be 4, 5, 6 years in the future in order to make that more long-term purchase. What's happening in the US economy on a longer term basis is that income growth, specifically real income growth, which is the most important, the growth rate is falling. So real income growth is still positive, but the growth rate is falling. So real income growth used to maintain a 3% level, then it fell to a 2.5% level. Then it fell to a 2% level, and now we're growing less than 2% in real income terms. So if you take the compounding effect of growing at 3 versus growing, let's say, at 1.5, and you extrapolate that 5, 6, 7 years in the future, what happens is there's a gap that develops between where you thought you would be and where you are. In the US economy, since this deterioration in real income growth has been happening for so many years, it feels very subtle on a year by year basis. But when you look back over 20, 30 years, there's a huge gap that's developed between where people thought they would be and where people are now, which is what's giving the feeling of discontent with the overall economy, or the feeling that we're falling behind. As people fall behind, they're much less likely to move into household formation. Most people think that as soon as you turn 30 years old or 35 years old, you automatically move into the household formation years and start having kids just as a automatic trigger by function of your age. But what we're finding in all the developed economies that are experiencing this deterioration is that the household formation and family formation process is not occurring, or it's being significantly delayed because people are not comfortable with their economic situation, which means that they're much less likely to take on additional financial dependence in the form of a family. And that's causing fertility rates and birth rates to collapse in all the developed countries, with the most recent data in the United States saying that the fertility rate is down to 1.6, which is the lowest level ever recorded. So there's something very deep going on in all of the developed economies that's causing a very significant decline in birth rates. In the US, the decline started right around 2008, which is not a coincidence. So, in my view, based on the research which I presented in the video, it's because of the slow but consistent degradation in real income growth that's making people feel like they're falling further and further behind.
In Canada, where I live, I think 97 or 98% of the population growth in 2023 was from immigration. So the birth rate was like negligible, or new births was
Exactly.
negligible. So this is a trend, like you pointed out, that's happening all across the globe, all across developing nation or developed nations rather. It's not just the U.S. The global fertility rate is falling. So
Mhm.
can we extrapolate this and say, well, the real income growth rates of developed nations are also perhaps falling as well? Not just
Absolutely.
outside US, it's a global phenomenon. Yeah.
Absolutely. So when you look, mainly what we're talking about here is China, Japan, Europe, United States, and Canada. Those countries all are basically experiencing the same situation, and it's extremely tied to home prices and the housing situation. So as home prices get more unaffordable, which is just a derivative of real incomes falling effectively. It's looking at the two sides of the same coin, basically. Um, as housing gets increasingly unaffordable, or as real income growth slips further and further from its long run trend, it's more difficult for younger folks to move into homes. It's much more likely that you're going to start a family if you move into a home. And that process is being very, very, very severely delayed to where people aren't buying their first home until, 40 as opposed to 35, as opposed to 30. And that, in my view, is what's contributing. Of course, there are other factors at play. We can never say it's just one
You
factor,
know,
but
it's
that's
interesting because over the
huge.
last couple of decades, as income levels rose, especially for women, where we're seeing that people are delaying getting married. The average age of marriage for women have has gone up in developed countries. Um, Correlating with their rise in income and overall levels of education. But now what we're seeing is fertility rates decline and the rate of growth of incomes also decline. It's fascinating because before it was going down because people were getting richer, but now you're saying they're less rich. We're getting less,
Right.
becoming less rich, and they're still
Yeah,
going
no, no,
down. Yeah.
you make a good point. So when we look at the fertility rate data, it was very, very high in the 1950s, let's say 1940s, 50s, and
Hmm.
60s. I think if I recall, it was up, over three was the average, meaning average woman having three births, so more than
Yeah.
three births. Um, that fertility rate plummeted through 1975 as women entered the workforce. But then the fertility rate increased from 1975 to 2008. That was a period where women entered the workforce. So households now had dual incomes, and real income growth was maintaining a very stable trajectory. So the fertility rate from 1975 through 2008 was moving upwards. 2008, speaking in the United States, of course, the 2008 recession occurred. And from that year forward, there's been a very consistent and steady decline in the fertility rate. A lot of data that we can point to that the economy structurally has never recovered from the 2008 recession, and that's put a lot of pressure on the average American Very similar situation abroad. So you do make a good point. So fell very dramatically until 1975, rose until 2008. After 2008, it's been declining, and all indications are that it's going to keep declining as the situation continues to intensify, which it sure looks like it will.
Have you done any research on unemployment and fertility rates? Is there a relationship there?
That's a good question. No, I have not looked into that correlation, but that's certainly
Yeah.
something I should do.
Okay. Well, you have a lot of interesting research that you have done. So where can we follow you and learn more?
Yeah, so most publicly on Twitter as well as YouTube. And for everything else, you can go to epbresearch.com. We have a free business cycle training course that explains how I look at the economy, and we have some subscription services as well as private consulting services on there as well.
Okay. Very good. Thank you very much, Eric. I appreciate your time. And don't forget to follow Eric in the links down below. We'll see you next time, Eric.
Good to be with you, David. Thanks.
And thank you for watching. Don't forget to like and subscribe.